Imagine signing a legally binding contract today that, dictates exactly how a massive portion of your income will be spent every single month until the year 2056.
Yeah, that is a terrifying thought when you just lay it out like that.
Right. When you put it in those terms, buying a home sounds absolutely terrifying, yet it's pitched to us as this incredible emotional milestone.
Oh, definitely. It's totally sold as the American dream.
Exactly. I mean, you walk into an open house, you see the afternoon light hitting those original hardwood floors, you look at the kitchen island, and you instantly start imagining your life there.
You start mentally placing your furniture.
Yes, you're picking out where the couch goes, but the math waiting for you at the closing table, it has no feelings whatsoever. It is utterly ruthless.
Ruthless is the perfect word for it.
So we are pulling our insights today from a really comprehensive guide by Legit Calc. It's titled Mortgage Calculator Dash Legit Calc Dash Free Online Financial Calculators.
A very thorough source.
It really is. And the mission for this deep dive is to explore a crucial yet somehow constantly overlooked preliminary step in homeownership.
Which is so surprising given the stakes.
Truly, we're talking about the supreme importance of using an online mortgage calculator before you even start looking at houses.
Yeah, before you even open Zillow or talk to an agent.
Okay, let's unpack this. Because house hunting without using a mortgage calculator first is basically like, well, it's like going to the grocery store on an empty stomach with no budget.
That is a recipe for disaster.
You're going to fall in love with something you absolutely cannot afford.
And if you are looking at housing prices right now, I mean, the macroeconomic environment is incredibly intimidating.
Oh, it's brutal out there.
It is. We're dealing with historically volatile rates, shifting valuations, and just a really high cost of living overall.
Yeah, everything costs more.
Right. So relying on a calculator to run different financial scenarios before you even talk to a real estate agent, it isn't just a helpful little administrative task. It is a vital survival skill.
Survival skill. I like that.
It really is your ultimate shield against a 30-year financial mistake. But, before you can truly wield that tool, you have to understand the mechanisms of what it is actually calculating.
Which is not as simple as people think.
Not at all. A really dangerous misconception for a lot of first-time buyers is that a mortgage payment is just the price of the house divided by 360 months.
I mean, if only. If only it were that simple. The actual formula running in the background is this massive, recursive, algebraic nightmare.
Oh, yeah, it's intense.
So it's like M equals P times R times 1 plus R to the nth power, all divided by 1 plus R to the nth power minus 1. It's ridiculous.
Yeah, you are not doing that on a napkin at a coffee shop.
No way. It basically calculates how your interest snowballs against your principal every single month based on the exact rate of decay of your loan balance.
Exactly, which is why the digital calculator handles all that complex algorithmic heavy lifting instantly.
Right. But the principal and the interest, that's just the baseline.
It's just the tip of the iceberg.
Yeah. The real shock comes when you realize the real estate industry operates on an acronym, which is PITI.
Yes, PITI.
Principal, interest, taxes, and insurance.
And those last two letters, the taxes and insurance, those are the hidden variables where a lot of buyers get completely derailed.
Totally derailed.
Let's look at the T in PITI. Property taxes are assessed locally by counties and municipalities, and they can dramatically shift your actual monthly cost depending on literally just where you drop a pin on the map.
It's wild how much it varies.
It is. The Legit Calc Guide gives a brilliant example of this geographic variance. So say you buy a $300,000 home in Texas.
Okay, Texas.
Your annual property taxes there might be around $6,000 because of how their state revenue is structured.
Right, because they don't have a state income tax, so they hit you on the property.
Exactly. But if you buy a home for that exact same purchase price of $300,000 in Hawaii, your taxes are only about $900 a year.
Wait, $900 for the whole year?
A whole year.
Okay, so I did the math on that before we started. That translates to a $425 difference in your monthly payment for the exact same purchase price.
Just because of state lines.
Yeah. You could buy the identical house, but your monthly burden changes drastically.
And those local tax quirks are just one layer of the hidden costs.
Yeah.
You also have to factor in the I in PITI, which is insurance.
Right, homeowners insurance.
Yeah, homeowners insurance protects your property against catastrophic events, like fires or storms.
Yeah.
But there's another type of insurance that often catches buyers entirely off guard.
Oh, I know where you're going with this.
Yeah, private mortgage insurance, or PMI. If you put down less than 20% of the home's purchase price, the lender is almost certainly going to require you to carry PMI.
Which is so common now. Who has a 20%?
Almost no first-time buyer.
Right.
And it usually costs between 0.5% and 1% of the total loan amount annually.
Okay, wait, so let me get this straight. I just want to make sure I fully understand the mechanism here. PMI protects the lender in case you default on the loan, but you are the one who has to pay the premium for it every single month.
That is exactly how it works.
That is wild. That feels incredibly backwards. You're forced to buy an insurance policy where the bank is the sole beneficiary.
I know. It feels like a bitter pill to swallow. But look at the mechanism of risk from the lender's perspective for a second.
Okay, I'll try to be objective.
You have very little skin in the game with a low down payment, say, 3 or 5%. Statistically, a borrower with very little equity represents a much higher default risk.
Because they have less to lose if they just walk away from the house.
Exactly. PMI is really the only mechanism that allows banks to justify lending to first-time buyers at all without requiring them to save up a full 20% in cash.
Which, let's be honest, in today's market could take a decade.
Or longer.
I guess that makes sense mechanically, even if it really hurts the wallet. The bank needs a buffer. But how does the calculator actually help manage this?
Well, what's fascinating here is why the calculator's breakdown is so vital. It lifts the veil on how these extra costs are handled through escrow accounts.
Ah, escrow, the magic word.
Right. An escrow account isn't just a convenience feature to help you budget. It's basically a defensive moat for the bank.
A defensive moat? How so?
If you fail to pay your property taxes, the local government can put a tax lien on the house, right? And that actually supersedes the bank's claim.
Oh, wow. I didn't realize the government gets in line first.
Always. And if you fail to pay your insurance and the house burns down, well, the bank's collateral is just completely gone.
Poof, just up in smoke.
Exactly. So escrow exists so the bank can guarantee those risk-mitigating bills are paid first, directly by them, using your money.
They just collect it up front every month.
Yes. And by factoring in the full PITI from the start, the calculator shows you exactly how taxes and insurance artificially inflate your baseline principal and interest.
So you don't get blindsided later.
Precisely. It prevents the dreaded payment shock. That terrifying moment when you think your mortgage is going to be $1,800, but the bank tells you the actual check you need to write every month is $2,400.
Yeah, that's a heart attack waiting to happen. Okay, so we've seen how the calculator shows us the true anatomy of the payment.
Right.
But here's where it gets really interesting. Because this is where we shift from just looking at the math to actually manipulating it.
This is the fun part.
It is, because the digital sandbox lets you pull different levers of time and money to see how the numbers react. I was playing around with the amortization schedule tool, and I noticed something fascinating.
What did you see?
Bumping up from a 30-year to a 15-year term, it increased my monthly payment significantly, but it wiped out an unbelievable amount of total interest over the life of the loan.
Oh yeah, it's staggering.
What is the actual mathematical engine driving that massive discrepancy?
So the amortization schedule is essentially the DNA of your loan. It shows the exact mathematical decay of your principal versus the interest extracted by the bank over those 360 months.
The slow bleed.
The very slow bleed. When you look at the raw numbers, the guide breaks down a $300,000 loan at a 6.5% interest rate.
Pretty standard numbers right now.
Yeah. If you choose a standard 30-year term, your monthly payment is $1,896. Now, if you compress that to a 15-year term, your monthly payment jumps to $2,613.
Ouch, that's a big jump.
Right, so it costs you $777 more a month out of pocket.
Which is a lot to swallow.
It is, but by paying that extra $717, you save over $160,000 in total interest over the life of the loan.
Wait, really? $160,000?
Yes.
That is the price of a small condo in some cities, just vanishing into thin air because you sped up the timeline? How does changing the timeline delete that much money?
It happens because of how banks structure the amortization curve. Interest is calculated monthly on the outstanding balance of the loan.
Okay, tracking with you.
In month one of a 30-year mortgage, your balance is huge. So out of that $1,896 payment, the vast majority is going straight to interest.
You're just paying the bank's fee, basically.
Exactly. You are barely chipping away at the actual core debt. The payments are heavily front-loaded in the bank's favor.
Which feels like a scam, but I know it's just math.
Right. So when you compress the term to 15 years, you are forcing a massive chunk of principal to be paid down immediately.
Because the payment is so much higher.
Exactly. And that drastically shrinks the balance that the bank can charge interest on in month 2, month 3, and so on. The balance falls faster, so the interest calculated on it drops exponentially.
But let's be real, a 15-year term feels way too tight for a lot of budgets, especially right now with groceries and gas being what they are.
It's definitely a luxury for a lot of people.
Yeah, locking yourself into a mandatory higher payment is risky. But the calculator has an extra payment feature that acts like a fantastic middle ground.
This is one of my favorite tools.
Mine too. The guide shows that if you stick with that standard 30-year loan, but you just add $100 extra a month.
Which is basically giving up like a couple of streaming services or eating out once.
Exactly. Just $100 extra, specifically applied to the principal. It saves over $52,000 in interest.
It's incredible.
And you pay off the loan 5 years and 7 months early, just from an extra $100 a month. Looking at the amortization schedule through a calculator is like finding a cheat code in a video game.
A cheat code, I love that.
It is. Throwing just an extra $100 a month at the principal drastically shrinks the final boss's health bar.
Mechanically, that cheat code works because you are bypassing the normal amortization curve entirely.
You're just stepping outside their system.
Pretty much. That extra $100 doesn't get split between principal and interest. It goes straight to the core debt. It creates this outsized butterfly effect on the entire life of the loan.
Because it snowballs.
Exactly. Every dollar of principal you eliminate today is a dollar that cannot be charged interest for the next 29 years.
Mind-blowing. And there's another trick in the guide to bypass that curve, which is making biweekly payments.
Oh, this is great strategy.
Yeah. If you set it up to pay half your mortgage every 2 weeks, you end up making 26 half payments a year. That magically equals 13 full payments.
Right. Because there are 52 weeks in a year.
Exactly. You sneak an entire extra payment into the year without really feeling a massive hit in your standard monthly budgeting cycle.
It's such a seamless way to accelerate the payoff.
It really is.
Now, we've seen how manipulating the timeline can save you a fortune in interest. But, the calculator's internal math is entirely dependent on an external variable you bring to the table before you even hit calculate.
Let me guess. Your credit score.
Your credit score.
Yeah, this is the reality check portion of the deep dive.
Yeah.
Your unique financial fingerprint bends the reality of the calculator.
If we connect this to the bigger picture, the guide lays out the stakes really clearly here. A 100-point difference in a credit score can shift your interest rate by 0.5% to a full percent.
Which sounds tiny, but it's not.
It's massive.
Sure.
When the bank evaluates your credit file, they are pricing risk. A lower score means a statistically higher chance of default, so they charge a higher premium for lending you the money.
Just like car insurance.
Exactly. Let's look at that same $300,000 loan. A 1% lower interest rate saves you about $175 a month.
Okay.
That translates to over $63,000 in savings across 30 years.
63 grand. That is the cost of a luxury car, dictated by a 3-digit number attached to your name.
It's pretty sobering.
Very. The guide points out that if your score is borderline, just a 50-point increase is worth waiting 3 to 6 months to achieve before you buy.
Absolutely. From an ROI perspective, taking a few months to pay down revolving credit card debt or dispute errors on your credit report, that yields one of the highest returns on investment you can possibly get for your time.
100%.
Now, once you have your rate dialed in, the calculator helps you navigate around some very common budget illusions.
Illusions meaning things that look fine on paper but destroy you in real life.
Exactly. For example, the industry uses the 28-36 rule. Lenders generally want your total housing payment to be under 28% of your gross monthly income.
Okay, I need to push back on this, or at least point out how dangerous that is for the average buyer.
Go for it.
Lenders use gross income. That's the amount you make before taxes, health insurance, and retirement contributions are taken out. Why do they use gross? We don't live on our gross income. We live on the net amount that actually hits our checking account.
It's a valid point. Lenders use gross because it is a standardized pre-tax metric. Tax situations vary wildly from person to person based on deductions, dependents, and write-offs.
Sure, it makes their math easier.
Exactly. Gross income provides a clean, verifiable baseline for their underwriting models. But, you're highlighting the exact trap the guide warns about. The calculator knows the math, but it doesn't know your lifestyle costs.
Right. The calculator tells you what the bank says you can afford based on a pre-tax fantasy number. It doesn't tell you what you should afford.
Those are two very different numbers.
Totally different. It doesn't know how much you spend on daycare or student loans or groceries or travel.
And that's why relying solely on the 2836 rule in a high inflation environment can leave you completely house poor. You also have to factor in closing costs, which buyers constantly forget because they aren't rolled into the monthly payment.
Oh man, closing
They
costs.
are a brutal upfront reality.
We're talking 2% to 5% of the home price. On a $300,000 home, that is $6,000 to $15,000 in cash you need at the closing table on top of your down payment.
It's a huge hit.
You have appraisal fees, title insurance, origination fees. People drain their entire savings account for the down payment and get completely blindsided by these closing costs.
Another massive pitfall is using national averages instead of local numbers for taxes and insurance in the calculator.
So yeah, you can't just leave the default numbers in there.
Right. If you use a national average for taxes while buying a house in New Jersey or Texas, your calculated payment is going to be a complete fiction. You have to input localized, accurate data for the math to hold up.
The guide suggests a brilliant reality check to test all of this. If the calculator says your fully loaded new mortgage will be $2,500 and your current rent is $1,800, well, try putting that $700 difference into savings every single month right now.
I love that exercise.
It's genius. See what it feels like to live on that proposed budget? If it feels like you're suffocating, you need to look at cheaper houses.
It is so much better to find out you can't afford that lifestyle before you sign a 30-year contract.
Exactly, before you're trapped.
That stress test forces the abstract math into your daily lived reality. And it leads us perfectly into the final phase of our deep dive. As powerful as this digital tool is, it definitely has blind spots. We have to talk about its kryptonite.
Yes. When do you put down the calculator and step into the real world?
This raises an important question. Calculators are flawless at math, but they fall short on specific real-world variables. A public online calculator does not know your exact verified credit profile. It doesn't know the specific origination fees a particular lender is going to charge you to underwrite the loan. And it certainly doesn't know the volatile daily reality of interest rates.
The rate you see today might be gone tomorrow. Mortgage rates are tied to the broader bond market. They fluctuate daily. Rate locks usually only last 30 to 60 days.
Which is a very tight window in real estate.
Very tight. If your closing gets delayed because of an inspection issue or, I don't know, a paperwork snag, that rate lock could expire. If rates have gone up, that slips through your fingers, completely changing the math you've been relying on.
Exactly. So it comes down to the difference between pre-qualification and pre-approval. Pre-qualification is calculator territory. It's a rough estimate based on unverified numbers you just sort of typed in.
A guess, basically.
A very educated guess, but yes. Pre-approval is lender territory. It requires hard verification of your income, your assets, your tax returns, and a hard pull on your credit history. It is a formal commitment from the bank.
And the guide strongly recommends that when you move to that pre-approval stage, you shouldn't just go to one bank. You need to shop at least 3 different lenders to compare actual rates and fees, not just rely on the calculator's generic estimates.
The nuances of lender offers make a huge difference. One lender might offer a slightly higher interest rate, but they waive thousands of dollars in closing costs.
Which might be exactly what you need.
Exactly. If you only plan to stay in the home for 5 years, taking the higher rate to save cash up front might be the mathematical winner. Another lender might have a rock-bottom rate but charge steep origination points. You only see those trade-offs when you get actual loan estimates from lenders. The calculator is a sandbox for strategy, but only a lender provides a binding commitment.
So what does this all mean? Using a mortgage calculator is like spending hours in a highly realistic flight simulator.
Oh, that's a good comparison.
It teaches you all the controls, it shows you how the plane responds when you pull the levers of time and money, and it prepares you for turbulence. But getting a pre-approval from a lender, that is the only way you're actually allowed to fly the plane.
You wouldn't want to get in the cockpit without having spent time in the simulator understanding the mechanics of flight. The calculator gives you the muscle memory to navigate the real transaction.
Okay, let's bring this all together for you. We've covered a lot of ground today. We started by breaking down the true weight of PITI principal, interest, taxes, and insurance.
The big four.
We explore the defensive mechanics of escrow and how knowing your fully loaded payment protects you from payment shock. We looked at how you can leverage the amortization schedule, like throwing an extra $100 a month at the principal to bypass the interest curve and save tens of thousands of dollars.
The cheat code.
The cheat code. We debated the danger of the 2836 gross income rule, discussed the massive value of delaying your purchase to fix your credit score, and finally, we covered the hard limits of what a calculator can actually promise you.
Before we wrap up, I want to leave you with a final thought to mull over.
Hmm.
We are so conditioned by society and the financial industry to think of a 30-year mortgage as this heavy, static, immovable weight.
A 30-year sentence that we just endure.
Right. But the calculator proves mathematically that it doesn't have to be. What if we started viewing our mortgage not as a fixed monthly bill that simply happens to us, but as a highly flexible financial instrument?
Wow.
An instrument that we can actively manage, manipulate, and optimize month to month to strategically build our own wealth.
That completely flips the script. You go from being a passive payer who just hands over a check to an active strategist controlling your financial timeline. It puts the power back in your hands.
Exactly.
Thank you so much for joining us on this deep dive into the source material. We highly encourage you to go find an online calculator like the one at Legit Calc and just start playing in that sandbox. Run your numbers, stress test your limits, and remember, figure out your budget before you fall in love with the house. We will catch you on the next deep dive.